Today we're tackling a topic of immense interest and concern, the potential timing and impact of the next housing market crash. It's a given that the market will face downturns, so our focus is on understanding the current dynamics of the real estate sector, evaluating the likelihood and extent of a future crash, and, crucially, discussing strategies to best navigate these possibilities. Let's begin with a brief note of appreciation. If you find our discussions insightful, I'd be grateful if you could show your support by liking this video and subscribing to our channel. Your engagement is invaluable, and in return, I'll strive to interact with your comments. The term frozen in the context of the housing market is quite illustrative. It suggests a state where activity is significantly slowed down, if not at a standstill. This stagnation is multifaceted, impacting various aspects of the housing market. High interest rates. One of the most significant factors contributing to this frozen state is the rise in interest rates. When interest rates increase, the cost of borrowing money becomes more expensive. This directly impacts home buyers, as higher mortgage rates mean higher monthly payments. Consequently, many potential buyers are priced out of the market, leading to a decrease in demand. This is particularly impactful for first-time home buyers or those in lower income brackets who are more sensitive to changes in borrowing costs. Impact on sellers. From the seller's perspective, high interest rates also have a dampening effect. As buyers retreat, sellers find fewer takers for their properties. This leads to a longer time on the market for listed properties and can result in a decrease in listing prices in an attempt to attract buyers. However, a unique situation has arisen in 2023 where, despite these conditions, home prices have not fallen but have instead reached new highs. Record home prices. The continuous rise in home prices amidst these conditions is somewhat paradoxical. Several factors contribute to this. Firstly, there's a persistent shortage of housing inventory in many markets, a trend that predates the pandemic but was exacerbated by it. This shortage means that even with reduced demand, there is still enough competition among buyers to keep prices high. Population growth and housing demand. The population continues to grow, and with it, the need for housing. This inherent demand underpins the market and provides a floor for how low prices can go. Even in a challenging economic environment, people still need places to live, and this fundamental demand can keep the market from collapsing entirely. Lowest number of home sales since 1995. The culmination of these factors, high interest rates, a decrease in buyer demand, and persistent high prices, leads to a significant drop in the number of homes being sold. This reflects a market where many potential buyers are waiting for conditions to improve, and sellers are reluctant to low prices. It's a stalemate situation, with each side waiting for the other to blink. Record low pending sales. Pending sales, or sales that are under contract but not yet closed, are a leading indicator of the housing market's health. A record low number in pending sales suggests that not only are fewer transactions being completed, but fewer are even being initiated. This indicates a broader hesitation in the market, with both buyers and sellers taking a cautious approach. The 2023 housing market presented a complex picture. High interest rates have suppressed buyer activity, but sellers are not yet lowering prices significantly, leading to a stagnation in market activity. Despite this, the underlying demand driven by population growth and the housing shortage keeps the market from a complete downturn. It's a delicate balance, reflective of broader economic conditions and indicative of a market in flux, waiting for either economic conditions to change or for market participants to adjust their expectations. The ripple effects of these trends are significant. Home builders are grappling with increased financing costs, leading to a 3.2 million unit shortfall in housing across the U.S. This shortage continues to drive up prices, making the market increasingly difficult for buyers. As we look towards 2024, it's essential to balance the potential risks and opportunities. Affordability, or rather the lack of it, is a primary concern. Current market conditions reflect the worst affordability scenario since 1984. According to CNN, nearly 40% of the median household income is now required for an average home purchase, exceeding the 30% threshold that typically defines affordability. This scenario has rendered the majority of the U.S. housing market inaccessible for average Americans. The relationship between unemployment rates and the housing market is a crucial one, often reflecting broader economic trends and directly impacting housing affordability and market dynamics. Let's delve deeper into this aspect. Current low unemployment rates. As of 2023, unemployment rates are relatively low. low unemployment typically signals a strong economy, where job security and rising wages can bolster consumer confidence, including in the housing market. Home buyers are more likely to commit to large purchases like real estate when they feel secure in their employment. Historical unsustainability of low unemployment. However, historically, periods of very low unemployment haven't been sustainable over the long term. Economies are cyclical, and phases of growth and recession alternate. When unemployment is exceptionally low, it can signal an economy operating at or near its peak, which often precedes a contraction. Economic cycles and unemployment spikes. Economic downturns often lead to increased unemployment. Businesses facing lower revenues and tighter budgets may lay off employees or freeze hiring. This rise in unemployment typically follows periods of economic expansion, as seen in past economic cycles. Such spikes in unemployment can quickly change the dynamics of the housing market. Impact on housing affordability. Increased unemployment directly impacts housing affordability. Even those who retain their jobs may experience uncertainty and reduced confidence, making them less likely to invest in major purchases like homes. For those who lose their jobs, the immediate impact is more severe, often forcing them to delay or cancel plans to buy a home. This reduction in demand can lead to a cooling of the housing market, potentially lowering prices, but also signaling a less active and healthy market overall. The ripple effect on the housing market. As unemployment rises, the cascading effects can be significant. There can be an increase in homes sold due to financial distress, leading to a rise in inventory and potentially lower prices. However, the overall reduction in buyer demand can mean these homes stay on the market longer. Additionally, lenders may tighten their borrowing criteria in response to increased economic uncertainty, further limiting the pool of potential buyers. Regional variations. The impact of unemployment on housing markets can vary significantly by region. Areas with diverse economies might weather economic downturns better than those reliant on specific industries. For instance, a region heavily dependent on manufacturing might be more severely affected by job losses in a downturn than a region with a more varied economic base. Long-term considerations. While the spike in unemployment can cool the housing market in the short term, the longer-term outlook can vary. Post-recession recoveries often bring renewed job growth, increased consumer confidence, and a resurgence in housing market activity. Moreover, government policies and interventions, such as stimulus packages or interest rate adjustments by central banks, can mitigate the impact of rising unemployment on the housing market. The threat of a recession in 2024 cannot be overlooked. Should a recession occur, it could further weaken housing demand. Fannie Mae's analysis points to the unsustainable nature of current personal consumption levels relative to incomes. Moreover, the long-term effects of monetary policy tightening are still unfolding. Consumer sentiment aligns with these economic indicators. A recent survey showed that just 16% of respondents believe now is a good time to buy a house, indicating historically low consumer confidence. Interestingly, high mortgage rates have now overtaken high home prices as the leading deterrent for buyers. However, the housing market isn't only about gloomy forecasts. Several factors could invigorate the market. For example, a reduction in interest rates could stimulate buyer interest. Additionally, an anticipated decrease in rates might encourage homeowners to sell, potentially leading to an influx of inventory. Historical data also supports the resilience of the housing market. Long-term trends have consistently shown an upward trajectory in housing values, with few exceptions. This pattern is likely to persist, underpinned by population growth and a lag in new construction. In light of these insights, here are my strategic recommendations. 30-year mortgage. This option offers flexibility, allowing you to make extra payments when feasible while providing a safety net during tougher times. Fixed interest rate. In an unpredictable economy, locking in a fixed monthly payment offers a sense of security. Refinancing opportunities. Keep an eye out for chances to refinance, especially when interest rates drop. This can lead to significant savings over time. Hold off on selling. Unless necessary, avoid selling your property. Real estate is a long-term investment, and its value is most relevant when you plan to sell. Emergency fund. Unforeseen property expenses are inevitable. Having a dedicated emergency fund for such occasions is prudent. Affordable purchasing. Ensure that your property purchase aligns with your financial capacity. Aim to keep housing expenses within 25 to 30% of your income for financial stability. Now, while the housing market faces uncertainties, its historical resilience suggests that prudent, long-term investments remain a viable strategy. Nevertheless, remember, your support is crucial for our channel, so don't forget to like and subscribe and drop us a comment below and I'll be sure to respond. Thanks for watching, and here's to a prosperous future in real estate investing. See you on the next video!